Hi, and welcome back again to the latest edition of Tim Bigham's Big Time Options, Edges and Hedges, taking a look at UOA Today, unusual option activity that sets up for a couple big trades on Meta platforms, which was at the top of the list of unusual option activity on Friday. So, as we always like to do, we like to take a look at a fusion approach combining fundamental, technical, and most importantly, implied volatility or IV analysis. So let's jump in and take a look, shall we? Here's the scanner from Friday, one of the two that I look at. You can see Meta at the very top of the list, over 1.5 million option contracts traded versus a little over 600,000 average, more than 2.5 times the normal volume. You can see that IV is now at the highest level it's been over the past year. It was all on kind of a upgrade from Bank of America, putting it on their kind of conviction list, right? And call buying ruled the day, as we'll see in a second here. Here's the Thinkorswim UOA scanner that I built, right, that identifies unusual option activity, right, that exceeds the open interest, right? That's one of the hallmarks. And most importantly, lifts the implied volatility. In this case, at least two vol points. Top of the list, the Meta July 24th expiration 700 calls. You can see a ton more of Meta, all calls hitting the tape as well. So certainly some unusual option activity, sets up ideally for a couple of vol capture trades that we'll take a look at as a second. As I said, we like to look at fundamentals certainly as part of the overall trade identification process. Here's a quick look in the price to sales chart on Meta and price to earnings chart. You can see how recently price to sales has just exploded, certainly on Friday as well. Same thing with price to earnings, not at the highest level we've seen year to date, but certainly approaching it. That 8 times price to sales has kind of been a pushback here. It did go up to 9 briefly, but the upside will probably be capped from a multiple expansion, certainly on Meta. Same thing with PE, not at the highest levels, but well off the lows around 20, now approaching 25 times X. Here is that upgrade from Bank America. It basically came out and said enough about Meta burning through too much cash, right? They think it's all well worth it, right? They added them to their basically conviction buy list, right, with Goldman uses, right? Basically the US 1 list is called, right? Highest conviction buy rated ideas. That got everyone jumping in, especially as we saw on the call side with all that call buying on the scan here, right, to jump in to follow that upgrade, right, going forward by B of A. We'll see if it works out, but the one thing it did absolutely do is lift implied volatility, and that's what we always like to keep an eye on. Here I pulled off the 120-day IV for Meta. You can see the explosion here now at by far the highest IV reading over the past 12 months. You can see it lifted across the entire term structure of vol, right? Looking back on a 20-day generalized look, you can see it was trading near 35 basically towards the end of June. Now we're over 55, that huge explosion, again at the most elevated level we've seen over the past year. You can see the huge amount of volume coming in, especially on the short end, but even the long end as well. IV lifting across the spectrum as well. Here's the Thinkorswim, 100 percentile, right? Massive amount of calls, basically 2 to 1 over put. So huge call buying, certainly driving that IV. I pulled off a 2-year chart. Here's a 360-day at the money 50 delta call IV. You can see we saw these brief forays up towards 40, right, from an IV on the at the money 360 day, but it exploded just through there over the past several days. So certainly looking for a reversion of some sort here, to say the least. Same thing on a shorter term basis. Pulled off the at the money 50 delta 120-day call, kind of a mirror of this chart here, but just looking at the calls, certainly because of put call parity. Puts and calls move in unison. You can see this huge ramp up has only been this high only once over the past 2 years. Got a little bit towards this level pretty much 2 years ago, and they had that huge reversion. You saw the huge spike, the pump, and then dump. We're looking for the same thing here, so sets up ideally for a couple vol capture trades. Really most of it is to have the IV revert. So taking a look first at the January of 2027 650 800 strangle, right, which would be going out selling the January 800 calls, which are well out of the money, right? The 650 puts, which are just slightly out of the money. I pulled off the comparative date from April 21st. The stock closed at just over 670, 670.91. You can see that that sell strangle, selling the 800 call, 650 put, trading just under 115 and trading right around a 37 or so IV, 269 days to expiration back then. Fast forward to Friday's close, we can see the stock basically at the same price, just under 670, right, by less than a buck. So pretty much the same price that it was on April 21st, but yet that same sell strangle, right, has now increased by over 6 points, right? We're seeing IV now at over 46 on average, right? And this is a trade that is pretty much delta neutral, right? Selling a negative 39, you'd be, and then selling a 38, you'd be one delta net long, about as neutral as it gets. Theta, though, is the key here, right? 25 and 19, so you'd be making 44 cents a day selling it now. Back then, right, you'd be making certainly some money on time decay, about 30 cents a day, 13 and 17, right, on that. So I did the comparative here, April 21st, the stock at 670.91, just over 670, that strangle, just under 115. Delta back then was actually flat, so it's as delta neutral as it gets. You'd expect to make 30 cents a day on time decay or theta, right? The IV back then, about 37 and a half. Your upside break even, which is simply 800 plus the strangle price, right? Because you're short the 800 call, 914.75. Downside break even, which is 650. Your short put less than 114.75, 535.25. The call was trading at 46.90, right? The put at 67.85, as you can see from these prices here. Fast forward then to Friday's close, we can see the stock virtually at the same price. It actually dropped $1.70, but we had 80 days pass, right? We had almost 3 months pass from April 21st to July 10th, right? But yet that strangle increased by over 6 points, right? Even though it was as delta neutral as you can be, right? And you should have been making a ton of money on time decay, right? If you have 80 days pass and you're expected to make somewhere around 37 cents a day, you'd expect to make almost $30 in time decay, right? But if you would have sold this straddle, right, you would have lost 637 because that's what the strangle increased. So your vol capture edge over 35 points. Why? Because you saw this huge jump in IV of over 24% from 37.5 roughly to 46.5. So this massive IV lift, right, generated this vol capture possibility. So we can certainly look to take advantage of this. So you have bigger upside break even because of the bigger premium you're getting on the sell strangle, right? A lower downside break even, bigger cushion by a big degree, right? Because of this huge jump in IV. You have less time to expiration, so shorter time frame, bigger cushion with a bigger credit certainly adds up to a trade with bona fide edge. I took a look from July 1st until Friday's close at the $800 sort of strike on the January 27th. You can see the IV back on July 1st, little shorter time frame, just under 41, closed on Friday at 46.5. So certainly a reversion of some sort will lead to a very nice gain on the trade. Another trade to consider is a longer term, as long as you can get sell straddle, right? Going out to December of 2028, right? Selling the 800 straddle, 800 call, 800 put, the 800 put in the money, right, by about 130 points back on April 21st. The call, right, well out of the money by 230 points, right. Pretty much delta neutral, slightly net short, believe it or not, because of the upward drift, right, on stocks factored into delta computation. But you'd be about 9 deltas net short, right. IV, as you can see, somewhere just under 40 IV. That trade priced at about 367 bucks. Fast forward to Friday, the stock again virtually the same price, dropped by less than 2 points on a $670 stock. Not meaningful, right? But that sell straddle, right, increased to over 400, from under 370 to over 400. Why? Because IV is now around 45. So did the same sort of scenario analysis here, going back to April 21st, the stock at 670.91. That December of 2028, 800 sell straddle priced at 367, roughly, right, somewhere around there. You'd be 9 deltas net short, slightly net short. Expect to make about 16 cents a day on time decay. IV just under 40. Your upside break even, which is 800 plus the premium received, 1166 and change. Your downside break even, 433.33, which is 800 less that premium received. So certainly plenty of cushion on this one. Fast forward to Friday's close. Again, the stock down $1.70, right? The straddle actually increased in price to $400 and change, right? Up over 33 points. And it actually became even shorter. Why? Because IV jumped, right? You saw the IV, which has the effect on delta computation on that. Theta increased as well. More time decay because the prices are higher. So 18 cents average time decay if you put this trade on, and the IV, as I said, exploded by over 15%, which long-term IV moving by a similar percentage is much more meaningful. This is a very big move for long-term IV. You can see that the upside break-even increased by 5%, as did the downside break-even. Interesting to note that with the stock dropping $1.70, the call price, right, the December 800 call, increased by 17 points. So if you had the stock down, but the call up, even with 80 days passing, right, the put with the stock down increased by about 15 times more, than it should have, over 16 points, right? The stock down less than $2. The put went up 16 and change, so certainly sets up ideally for another vol capture trade. So you'd expect here the expected drop in theta, right, by selling this straddle back in April 21st, right? You had time decay, right? All those 80 days, right? Making, roughly about 18 cents a day. You'd expect to make about 14 bucks, right, on time decay. You did have the stock drop $1.70, right? And since you were about 11 deltas net short on average here, you'd expect to make a little bit on that, 18 cents or so. So you'd expect to certainly make somewhere around 14.5 bucks, but trade actually went the other way by 33.5. So you have a huge vol capture edge of almost 50 points on this one. Why? Because you saw this huge jump in IV of 15%. So this sets up ideally again for a sell straddle trade long term, right? To take advantage of the fact that IV, because of all this call buying out there, has absolutely exploded. Here is that longer term IV. You can see it massively jumping up. We can also take a look at it down here in a similar nature. Here's the 800 strike from July 1st to Friday's close. You can see it's moved from just over 40.5 to over 45, the IV, simply because of all that call buying out there. Just looking for it to revert back. And let's just assume we get a 4-point reversion on IV. Not all the way back even to here, right? But somewhere back towards the 41 level, right? And given the fact we've seen this huge run up, right? A reversion back to this area, basically back to these recent highs is all we're looking for. So if we have that sort of reversion, right, the straddle, which is, as we said, trading around 400 bucks, 386.44 theoretically, it would drop to 354 and change, right, or 32 points lower simply by having IV drop 4 vol points. So it certainly gives a bona fide edge. We're not looking for a huge drop in IV, just a retracement back to where it was, right? Just a retracement back, not even to this level down here, but back towards this level here is all we need. So the margin requirement on these two trades, on that sell straddle, right, you're looking about a $13,000 margin requirement. I would say, you know, 15,000 certainly. Do want to give yourself a little bit of a cushion. The sell strangle 11.5, right? So maybe use 12,000 there. And of course, you do have to be approved for selling naked options in your account, but certainly provides a meaningful edge on either one of these trades, or a simple covered call if you like the stock heading higher, right? The fact that you can go out and in essence have the stock drop $1.70, right, but be able to sell call for $17 more. And even shorter term, right, if you want to take advantage here, the call went up 3 points in January of 2027, right, with this stock dropping $1.70. So a cheaper stock price, more expensive calls lends itself to a bigger buy right edge going in. So hopefully provide some insight how we go about identifying trades based on unusual option activity, how we look to capture that vol from a reversion of vol, not necessarily even back to where it was before, but just some of the way back here. But as we always like to say, trading is all about probability, not certainty. So you always want to position size accordingly, have your stops in place. If you don't know where to get out, you shouldn't be getting into the trade beforehand. But sometimes you just got to say, what the fuck, and go for it. And we know this ends badly. So until next time, as always, here's the good trading. Take care.